You have money in a bank account, maybe a checking account, maybe savings, maybe both. You think it's safe, it's insured, it's in a bank. What could go wrong? In 1929, millions of Americans believed the exact same thing. They had accounts, they had deposits, they had numbers on a piece of paper that said their money was there. And then, over the course of a few weeks, it wasn't. Not because they gambled, not because they made bad investments, because the system they trusted, the place they put their money for safekeeping, turned out to be something very different from what they thought it was. This isn't a video about predicting a crash. I'm not going to tell you the economy is about to collapse next Tuesday. What I'm going to do is show you a mechanism, a trap, that was built into the banking system in the 1920s that destroyed millions of families in the 1930s and that still exists, almost unchanged right now, today, in the bank where your money sits. And by the end of this video, you'll understand exactly how it works. The 1920s in America were electric. The war was over. The economy was booming. Consumer credit had gone mainstream. People were buying cars, radios, refrigerators, all on installment plans. The stock market was climbing every month. And for the first time on the scale, ordinary Americans, not just the wealthy, were putting their money into banks. This was new. For most of human history, if you had savings, you kept them close, under the mattress, in a jar, buried in the yard. The idea of handing your money to an institution and trusting them to give it back was a relatively recent experiment. And in the 1920s, that experiment was working. Banks were everywhere. Deposits were growing. Trust was at an all-time high. But here's what almost nobody understood, then or now. When you deposit $1 in a bank, you think the bank puts that dollar in a vault and holds it for you? It doesn't. It never has. The moment your dollar hits the account, the bank lends most of it out to someone buying a house, to a business expanding, to another bank. Your dollar doesn't sit still. It moves. This is called fractional reserve banking, and it means that at any given moment, the bank holds only a small fraction of what it owes its depositors. In the 1920s, that fraction was thin. Banks were lending aggressively, $10 out for everyone they held. The system worked beautifully as long as everyone didn't come for their money at the same time. Now, to be fair, this isn't some secret trick. It's how credit economies work. Without fractional reserve lending, mortgages would be rare and expensive. Small businesses would struggle to get loans. The system creates real value when it funds homes, factories, infrastructure. The problem isn't the mechanism itself. The problem is when people believe their deposit is sitting in a vault untouched, waiting for them. It isn't. It never was. And that misunderstanding is where the trap begins. Think about that. Your bank account isn't a storage unit. It's a claim on a system. The number on your statement doesn't represent cash in a vault. It represents the bank's obligation to pay you. And the bank's ability to honor that obligation depends entirely on one thing: that not too many people ask at once. In the 1920s, nobody asked. Everyone trusted the system. The money kept flowing in, the loans kept going out, and the machine kept spinning. For almost a decade, it looked like the safest arrangement in the world. It wasn't. October 1929. The stock market crashes. In 2 days, the Dow loses roughly a quarter of its value. But that's not the real disaster. The real disaster isn't on Wall Street, it's on Main Street. It's at the front door of every bank in America. People panicked. Not just investors, ordinary depositors, teachers, shopkeepers, factory workers. They lined up outside their banks and asked for their money back, all of it, right now. And the banks couldn't pay, not because they'd been robbed, not because they committed fraud, because the money wasn't there. It had never been there, not all of it. It was out in the world, tied up in loans and investments that couldn't be called back overnight. The deposits were real. The cash to cover them was not. Between 1930 and 1933, over 9,000 American banks failed. 9,000. Not investment firms, not hedge funds. Banks. The places where ordinary people kept their life savings because they believed it was safe. When a bank closed, the money didn't go somewhere else. It vanished. Families who had spent decades saving lost everything. Not because they took risks, but because they made the most conservative choice available. They put their money in a bank. And here's what makes it worse. The people who understood the system, bankers, financiers, the well-connected, many of them pulled their money out early. They knew what fractional reserve meant. They knew the math didn't work if everyone showed up at once. Think about a woman named Mary, a schoolteacher in Ohio. She'd saved for 12 years. Every month, a small deposit. She was saving for a house, a place of her own after a decade of renting. By 1929, she had almost enough. It was all in her bank. And one morning in November 1930, she walked to the bank and found the doors locked. A sign in the window, closed. Her 12 years of discipline, her house, gone. Not because she gambled, because she saved in the wrong place. Mary wasn't unusual. She was everyone. The immigrant who'd saved for 20 years. The farmer who'd finally put something aside. They were the last in line. And by the time they got to the window was closed. 1 ounce of gold in 1929 was worth about $20.67. A schoolteacher earned roughly $1,400 a year. After the crash, the ones who had gold still had gold. The ones who had deposits in a failed bank had nothing. The trap wasn't the crash. The trap was believing that a number on a bank statement was the same thing as money in your hand. It wasn't. It was a promise. And promises break. After the catastrophe, the government needed to restore trust. And they came up with an elegant solution. In 1933, Congress created the Federal Deposit Insurance Corporation, the FDIC. The promise was simple. If your bank fails, the government will make you whole. It worked. People came back. Banks refilled. The system stabilized. And for nearly a century now, no insured depositor has lost a penny in a bank failure. I did a full breakdown of how FDIC actually works in another video. The short version is this. Ratio is more than enough. And a systemic ratio is more than enough. In a systemic crisis, dozens of banks failing at once. The fund runs out, and the government steps in with its ultimate backstop, the ability to create new dollars. So the trap didn't disappear in 1933. It evolved. Before FDIC, the risk was straightforward. Your bank fails and you lose your money. After FDIC, the risk shifted. Your bank fails, the government creates money to cover it, and your money loses its value. You don't lose your dollars. You lose what your dollars can buy. The guarantee is real. The question is what the guaranteed dollars are worth by the time you get them. That same year, 1933, Roosevelt did something else. He made it illegal for Americans to own gold, forced citizens to sell at $20.67 an ounce, then revalued gold to $35. I covered this in detail in my video on gold's purchasing power across 2,000 years. The short version, a 40% devaluation of the dollar overnight. The people got their safe paper money. The government got the gold. The trap has two doors. One takes your savings outright. The other gives them back, worth less. Now let's look at today. Because the mechanism hasn't changed. It's just gotten more complex, with more layers and much bigger numbers. Layer 1, the bank itself. Your money is still not in the vault. In March 2020, the Federal Reserve reduced the reserve requirement ratio to 0. That doesn't mean banks hold nothing. They're still governed by capital requirements and liquidity regulations. But the specific rule that said you must keep a fraction of deposits on hand is gone. The safety of the system now rests on capital buffers, risk models, and above all, confidence. And confidence can crack overnight. In March 2023, Silicon Valley Bank proved it. $42 billion in withdrawal requests in a single day. The 16th largest bank in America, gone in 48 hours. The government stepped in and covered all depositors, even those above the insurance limit. The message was clear. We will create whatever dollars are necessary to prevent panic, which means the backstop isn't a fixed number anymore, it's unlimited, backed by the government's ability to print. Layer 2, the currency itself. Your deposits are denominated in dollars, and dollars are losing purchasing power every year. Not sometimes, every year. $1 in 1913 bought what takes over $30 to buy today. Your bank account might grow by 2 or 3% a year in interest. Inflation runs at 3, 4, sometimes more. The math is simple. Your savings are shrinking in real terms while they sit there. This is the quiet part of the trap. You don't need a bank run. You don't need a crash. You just need time. Every year, your money sits in a bank account, earning less than inflation. You're losing purchasing power. Slowly, invisibly, but relentlessly. $1,000 in a savings account in 2020 still says $1,000 on the statement today, but it buys less. The number didn't change. The world around it did. This is the psychological layer of the trap. Your brain trusts the number. The number says you haven't lost anything, but purchasing power doesn't care about numbers. It cares about what those numbers can actually get you at the register. Layer 3, the system behind the currency. The United States government currently carries roughly $36 trillion in debt. The interest payments on that debt now exceed the defense budget. The trajectory is not slowing down. Historically, there are only 3 ways a government deals with debt of this magnitude. 1, they raise taxes dramatically. 2, they cut spending dramatically. 3, they inflate the currency, making the debt easier to repay with cheaper dollars. Option 1 and 2 are historically rare. Politically, almost no government chooses austerity when there's an easier way. Option 3 is the path of least resistance. It always has been. Every empire that has faced unsustainable debt has eventually chosen inflation, not because it's wise, but because it's invisible. You don't see a bill for it. You just notice that everything costs a little more every year. And who pays for silent inflation? Savers. People with money in the bank. People on fixed incomes. People who trusted the system. Pull back. Look at the full arc. In 1929, the trap was mechanical. Banks lent out deposits, couldn't cover withdrawals, and collapsed. People lost their money because it was never really there. In 1933, the government installed a safety net. The FDIC guaranteed your deposits, but the guarantee was funded by the government's ability to print money. The risk moved from losing your money to your money losing its value. In 1971, Nixon severed the dollar from gold. There was no longer any physical constraint on how many dollars could be created. The trap's ceiling was removed. In 2020, reserve requirements went to 0. The trap's floor was removed. In 2023, we saw a modern bank run, and the government responded by signaling it would cover everything, regardless of the stated limits. The walls of the trap expanded again. Notice the direction. Every fix widens the trap. Every safety net requires more money creation. Every round of money creation weakens the currency your savings are denominated in. Today, you sit inside a system where your savings are denominated in a currency that loses value by design, held in institutions that aren't required to keep your money on hand, backstopped by a government that covers shortfalls by creating more of the very currency that's losing value. Each fix made the system feel safer. Each fix also made the underlying mechanism more dependent on one thing, the continuous creation of new dollars. And every new dollar makes every existing dollar worth a little less. I want to be clear about what this video is and isn't. This isn't financial advice. I'm not telling you to empty your bank account or buy any particular asset. What I am telling you is that the system has a design, and that design has consequences. Understanding the design doesn't require a degree in economics. It requires paying attention to what happened before and noticing that the pattern hasn't changed. The people who lost everything in 1929 weren't reckless. They were careful. They saved. They trusted institutions. They did what they were told was the responsible thing, and they were punished for it. Not because they made a mistake, but because they didn't understand the mechanism they were inside. The mechanism is the same today. The names are different. The numbers are bigger. The safety nets are more sophisticated. But the core, fractional reserve lending, fiat currency, debt-funded backstops, is identical. The question from 1929 is the same question today. It's not, will your bank fail? It probably won't. It's not, will you lose your deposits? You almost certainly won't. The question is, what will those deposits buy when you need them? And that's the real trap. Not losing your money, keeping it and watching it buy less year after year while the number on the screen stays the same. The most dangerous thing isn't a crash. It's confidence that a crash can't happen. Not because crashes are inevitable, but because the confidence itself is what keeps people from asking questions, from looking at the structure, from noticing that the architecture of 1929, the basic blueprint, is still standing. Updated, reinforced, expanded, but still standing. This isn't a recommendation to buy gold or any other asset, but it is a recommendation to measure your savings in something other than nominal dollars, because nominal dollars are designed to shrink. 1 ounce of gold in 1929 was worth $20.67. That same ounce today, you know the number. Divide your savings by the current price of gold. That's how many ounces your year of saving is actually worth. Not in dollars, in something whose purchasing power hasn't moved in 2,000 years. If you want to see that math across every era from Rome to today, I made a full video on it. It's on screen now. That number is your real position. Everything else is a statement on a screen. Drop your number in the comments. I want to see where you stand. I'll see you in the next one.